Good evening, everyone. If you can let me know on the chat, like usual, that you can hear me, that would be fantastic. Excellent. Thanks very much. Before we start, I would like to draw your attention to the disclaimer on screen that I will read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or as an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So welcome to tonight's Master the Trade webinar. As always, please feel free to put any questions you have on the chat the moment that you have them, and we will answer them. We'll answer as many as we can before the end of the presentation. So it's been an uncertain and nervous week for stock markets and currencies as we wait to hear for news on things like the Brexit talks, which we got today, and the US virus aid plan, and the talks there are ongoing. We're also 14 days away now from the US election, so lots to talk about. On to the structure for tonight. As you can see on screen, China has an increasingly important role in the global economy and the global dynamic for financial markets. Maurice Pomeroy will explain what this means, why it's critical when you're trading Aussie, and why going forward US-China relations remain important for retail traders to understand. He will then go on and talk about his real-time assessments for the markets right now. Roger Hawes will lay out our trading strategy 3, which is how to stagger your entry orders and build into a trade. And then Richard Adcock, a candlesticks expert, is going to explain how you use them as a sentiment indicator in your trading, and then he's going to go to the live Pepperstone charts to look at the markets right now. After that, like last week, Richard discussed understanding support and resistance levels. So this week, Roger is going to build on that by providing some guidance on how you can trade support and resistance, and then we'll go onto Morris. So Morris, over to you.
Thanks, Chris. Welcome back, everybody. Hopefully, many of you have been with us for the last couple of weeks and sort of follow us on this journey. Tonight, I think one of the things we need to understand for global markets, let alone foreign exchange and equities, the importance of China in global markets. Obviously, it's a superpower. It is one of the largest economies on the planet, and I think, you know, what I've put out here for you is a set of things just to glance through, just try and take in some of the size of this economy, and its impact on the world is absolutely huge. A couple of things to pick out of there. The third one down on the left hand side, they're battling the US for world #1 status. That has brought on this focus of trade wars with the US. The US is sort of looking in its rear mirror, can see large as life China sort of pushing up behind it, challenging its position on the global stage. And I think to some degree, I think the US has now sort of turned around to meet that challenge. And I think that is going to have global implications going forward. So I think it's something that we do need to be aware of, and what the implications of that are going forwards. And we'll talk about that in a slightly later slide. Obviously, we've seen stock markets move quite dramatically when Trump has turned around and targeted them on trade. You know, we seem to almost have a cold war in trade at the moment with the US and China. So obviously it's a major issue. Obviously, those that trade heavily with China, and none other more than Australia, will feel the threat from this. They've been mothballed or rather sort of cotton wool protected because they've had this association with trade with China. Through 2008, Australia didn't fall into recession like so many others did, because China was still sucking in raw materials from Australia. China is the largest purchaser of commodities, so that sort of helps Aussie again, and some other commodity countries out there, of course. But you know, Australia's biggest customer is obviously China, and they've almost mortgaged themselves to China's future. But within that, there's some interesting things going on now with a few trade tensions between China and Australia as well. So we'll be coming on to that later. But one of the things I want to pull up to you is if we start from the left-hand side of this chart here, where we see in January, China announced the outbreak of the virus. When we saw the US rate cut as well, we saw the dollar start to move down, but then the Aussie got hit pretty hard when the virus spread was become a global issue, and it was spreading across China quite quickly. We then saw the bounce as we saw China emerge from the lockdown. So Aussie then rallied all the way back up, and was very closely associated with China getting behind, or getting this virus behind it, and starting to see some return to economic growth. But then we've had this sort of nervous period now where we've seen relations sour slightly between Australia and China. We've had Australia go in and suggest, along with the US, almost taking sides with the US about an investigation into where the virus came from and how it was spread or let to go from China. We've seen China retaliate with imposing tariffs on barley, beef, wine imports. And just recently, we've had this issue with them banning coal imports from Australia as well. So the problem here is that we've got a situation where Australia is caught in the middle between its ally that is clearly clearly the US, and its trading partner that it is so dependent on in China. And some tough choices are coming up for Australia because of China. And again, it just shows you the impact this major economy is beginning to have on the global structure of things. And I think this is something we need to keep in mind, because what's happening here is we're seeing the US and China be dragged apart by Trump's trade wars, and we're seeing a polarization, if you like, between these two superpowers. Now, that is very important because that is going to have an impact on global trade going forwards. And these trade wars are not over. Obviously, we're on hold a bit for the US election, but you know, if we look at some of these headlines that we've got in the middle here, it shows you how aggressive this administration at least is. Now, many people feel that all this will disappear because the Democrats take over. But what I'm hearing from the Democrats as well behind the scenes is that they have a similar policy towards China. Whether it will be as aggressive or not, well, that would take some doing, I guess. But I do think they do seem to feel that there is an unlevel playing field in trade, and they may still pursue this over a period of time. So this polarization, I think, prevents growth in the global structure of things. So we have a more protectionist, insular looking world, which I don't think is good for global trade or global peace, to be honest. And I think Pacific Rim countries are being asked to take sides a bit here. And I do think that sort of is quite a vulnerable thing for Australia. And Australia, the Aussie dollar has actually underperformed over the last couple of weeks. For a couple of factors that we'll talk about later, but one of them being obviously their central bank being quite dovish, but the other one is certainly this trade spat going on with China, and I think that's quite important to bear in mind on a fundamental structure, but also some of the technicals, as Richard will highlight later, seem to be supporting that. So underperformance from the Aussie still looks like it could continue, and I think we really do need to ask ourselves, you know, how damaging this sort of polarization may be. So where are we right now in markets? I think, you know, we're at a bit of a crossroads. We've seen some quite decent moves in foreign exchange markets. On the global economic side of things, we have actually seen some pretty solid data out of China now, and I think what that has done has seen capital flow into China, and I'll explain that in a little while. But we saw, although GDP missed a very high expectation, it was still pretty good and beat the previous by, you know, 1.7%. And you know, we have got stronger industrial production, and retail sales were, well, they knocked it out the park really. So pretty interesting that their data is now coming back, almost back to where it was pre-COVID, having got this under containment, and shows you what we can do. But unfortunately, the rest of the world still very much struggling with the virus. And as we move into the dark days of winter, we've got some major impacts in the summer in the northern hemisphere. And the issue here is that we are dramatically seeing these increases start to fill up hospitals. We're starting to see the mortality rate start to rise. And as we get more and more lockdowns, it's almost a national lockdown via stealth. Gradually, we are beginning to lock down in parts of Europe, again in the UK, Northern Ireland, talking about it, Wales. And this is going to start damaging two things, and it's confidence and also potentially the economy as well. So I do think the virus needs to stay on the front of the headlines. Then it's not a lot of good news, although we are hoping that the speed of finding a vaccine can help us all, but at the moment that is still looking some way off. We did hear UK medical advisor saying we could have one or a number of vaccines ready for the start of next year. Okay, well, you know, as they say in this business, show me the money. It's not there yet. We had Fauci in the US having been very publicly ridiculed by Trump, suggesting that we may have a vaccine by the end of this year. Stocks didn't react to that at all. And I think I've highlighted at the bottom here, Mnuchin and Pelosi so far have failed to find an agreement on the US virus aid package, and this is what the market's waiting for in the States at least. Any positive headline on that, you'll see stocks rally, I think, and risk on throughout most assets. If it's negative again, I think we're so close to the election now. I think if there's not an agreement this afternoon, I think they're due to meet round about now, maybe for an hour or so. So even whilst we're on, we might hear something there. But if they don't get it done tonight, then I think we'll see quite a negative reaction to stock markets. And also there's this danger that we may have a lame duck presidency for 3 to 6 months, whatever, whilst they sort out everything, depending on who wins the Senate. And that could delay stimulus to the US economy that is badly needed. So that would be quite a negative. On the government side of things, we're still seeing Bailey and the Bank of England talking about negative rates and downside risks to the economy. That's the only script they seem to have. But you know, negative rates may be in the toolbox. I don't think they're going to use them unless we get a no-deal exit. Deputy Prime Minister Gove was telling the government, the Parliament, quite starkly that negotiations had basically ended. This was a concern. Sterling sort of fell, euro sterling rallied, but we have seen some olive branches sort of handed out by Barnier, who I think is potentially going to be over tomorrow for further talks on an intensified basis. Sterling had quite a big rally today, helped by a weaker dollar, but sterling against the crosses did very well today. So there's a lot of hope already priced in for this. So they do feel that now over the next 2 weeks they could get some talks pretty seriously and that a deal can be found. So I think there's a chance of that, but again, show me the money. Until it's done, I think we have to be very careful here. There's a lot of politics at play. I think we've still got the Fed speakers, all of them talking about more fiscal stimulus needed, some beginning to talk about even more monetary stimulus needed. And I think the interesting one for me at the bottom was the PBOC governor the other day said that the policy should focus on domestic demand and price stability, but the last bit, let the market exchange decide exchange rates. That was a key point for me, and I was telling my clients that I felt that was a precursor for a lower dollar, and dollar CNH, which is the offshore yuan, fell really, the dollar fell quite strongly, and the CNH rallied very strongly. And I think it's also helped by, as I mentioned earlier, this capital inflow into China, who seem to have put this virus behind them, and their economic data showing some real strength is attracting capital from other markets. And I think that's been part of the dollar weakness as well. But certainly worth keeping that on your screens. US dollar CNH, quite an interesting mover over the last couple of days. So I think we do need to have the US election now at the forefront of our thoughts. Where are we? Well, the last I saw today was 9 percentage points ahead for Biden on national scale. But more importantly, I think, as you'll see in the graph a little later, you know, he's winning quite a lot of the battlegrounds as well. But there's 2 or 3 things that we're looking that could happen here. The blue wave, as they call it. Now, if you hear anybody mention the blue wave, that's the Democrats winning both the House and the Senate. You know, they could then sort of certainly get through a very large stimulus package, which would possibly be seen as a positive for stocks now, although he also may want to sort of get some pretty big tax hikes back in there as well, which could dampen things if we get there. The outside liar is a Trump second term. Don't write him off. He was losing pretty substantially last time in 2016 and won it. So I think realistically, you're looking at a high risk, but it does at the moment look like a shoe-in for Biden. The interesting thing would be a split between the House and the Congress and the Senate. And the point is here is that you could have the best of both worlds. So you get more stimulus as they have the power to pass that, because the Republicans also want to get a deal done. But they may stymie or block the tax increases. So the market's beginning to think a split might actually be bullish. So we need to sort of keep that, because that's been in flux, those ideas, because the higher tax from Biden was also initially seen as negative for Wall Street, but they seem to have moved past that and see the stimulus as a greater benefit. So that's where we are with the election. And I think these states are the ones to watch. These are the ones I was talking about, the swing states, as we call, or the battleground states. Trump won a lot of these basically in 2016. At the moment, he's behind in most of them. So I think that could be quite an interesting structure. We have got more, we do have more polls coming out and expected, and we also have yet another virtual political interviews between the two. So I think it's going to be big news going forwards. We need this on our news screens, so make sure if anything to do with the election and polls comes up, we are going to start seeing markets move to them. So on that note, we can sort of project forward and look forward at what's coming. The things I'm focusing on at the moment, I think global stock markets do seem to be a bit of a crossroads. There's a great deal of hope being priced and placed on Brexit and the US aid plan. And a lot of it is price. So if we do get something positive from these, you know, how far can we still move afterwards is going to be a very interesting question. So I don't think it's going to be a straight line straight up for a long time on anything. Quite a lot of this is priced, so we need to be a little careful of what comes out there. So on that basis, I would still also be very keen to watch the data as we move into this fourth quarter. We've got some preliminary PMI data coming through over into the end of this week from the EU especially, the US as well and UK. This is forward-looking data, it is monthly, and I think being an early look into the fourth quarter, I think would be quite interesting. So I'm going to be taking a lot of notice of this, both services and manufacturing. Services probably more important for the US and the UK, manufacturing a bit more probably for parts of Europe. But services are the driver for many modern economies these days, with 70% plus in the UK and the US coming from services and the consumer. Still the uncertainty of the US election, which I've mentioned. The Brexit, obviously, we're now within possibly 2 weeks of something major. Boris is going to have to forewarn businesses that I'm not sure are ready for a clean break. So something needs to be decided very soon. That clock is ticking pretty loudly now. So I think holding sterling into the next couple of weeks is going to be quite hard. The interesting thing will be if the UK and European lockdowns are going to force central banks to do more. I do think we're going to get more from the ECB, so watch that. Whether that's going to be a negative for the euro or not, I'm not sure, but they have a very strong mandate to combat low inflation or deflation, and that's exactly what they've got in the EU at the moment. So I'm going to be looking for comments into the next ECB meeting to see if they start giving us a heads up on that policy change potentially. But I think the other thing that in there, talking about central banks, is that I do think we are looking at a potential move from the Australian central bank, which I'm going to talk about in a second. So on the currency side of things, dollar CNH has been falling, as I mentioned. I think the governor's comments were very clear. I think they were quite a shock to some people, certainly me. And I think the data is supporting this. They're trying to internationalize their currency, and so therefore they seem to be more politically allowing the currency to strengthen on good data and allow that capital to flow in. China needs foreign capital a lot more than they used to. And so I think this could continue, and that may continue to put a cap on the dollar. So I think we need to keep an eye on this and the importance of dollar CNH and what the shift in policy from China is doing for the broad dollar, because I think it's quite big. We are looking at a potential crossroads here for the dollar, but for me, it'd be interesting to see if we do get a sell-off in stocks, which would normally see the dollar rise. If that doesn't happen and that correlation is breaking, that would be a very bearish signal for the dollar as well. So to keep an eye on that correlation between risk off, dollar up, and risk down. Risk on, dollar down. So keep an eye on those two. I think if that starts to break, it should be a very significant signal that the dollar is just not going to rally. Talked about the ECB possibly doing more, but I do want to focus on the bottom one here. The Aussie is facing severe pressure from China over its trade and the virus. That's the fundamental. On top of that, we have the central bank talking about not only cutting rates potentially, and their next meeting is November the 3rd, the same day as the US election, funnily enough, but also they're talking about more QE and actually buying further down the curve, which would flatten the curve. One of the interesting things about that is that it should suppress the currency. We're seeing that being priced now though, so be careful with this. But also we have seen over the last many months that yield that was that interest rate, if you like, being higher in Australia has been attracting capital and investment, certainly from Japan, who have been ploughing into the Aussie to buy their bonds for the yield. That may now disappear, which would be a support for the Aussie possibly disappearing. So we need to keep an eye on that. November the 3rd is their next meeting, and it'd be interesting to see if the Aussie can hold above 70 cents, which has been a bit of a level just recently. And conscious of time, I'm going to skip across straight to events that matter for the rest of the week. And I've highlighted in red here that the major things, again, those who've been with us keep hearing me bang on about jobless claims. Possibly another 870,000 people in America could claim jobless benefits tomorrow. Keep an eye on that number. It's not coming off at the moment as people expected. If we get another rise, I think that could be seen as negative. I keep banging on about the importance of unemployment and the psychological impact on consumers. And I think the market needs to start really concentrating on this. Anything to do with the consumer. And then obviously we move into the PMI data, which starts with Australia, services PMI preliminary, and the manufacturing overnight. I will be very keen to see how that comes out, given the weakness and the dovishness from the central bank. And then we move into the yen, not quite so much, although we are seeing yen strength at the moment, having broken 105. Data doesn't usually impact the yen, but it might be interesting to see just how poor that economy is still performing. The presidential debate obviously is going to be of interest to see who wins that. But then sterling retail sales always important. And then the EU and GDP manufacturing and services PMI, we get the same in the US. I think these are important data, so we could have a choppy end to the week. So there you are, you're forewarned. You know, this stuff's on the diary. There's no reason for this to be a shock. So I think what you need to do is sort of plan your strategy going forwards. And what we're going to do is I'm going to pass you over to Roger Hawes, who's going to talk about a third part of his trading strategy, which is staggering entry orders, which is something I do all the time because I don't think I can ever pick a high or a low. So I try and step into these trades. And Roger's going to talk you through this now. Thanks, Roger.
Thanks very much, Mo, and good evening to everybody. Yes, so we're going to look at a strategy tonight, and I'm basing it off the fact that on one of the earlier seminars, we sent a strong message across about making sure you trade against the correct stop loss. And in some instances, this meant reducing the amount of capital or risk you put into the marketplace to make sure that your losses were covered and you weren't breaking any of your own personal limits or platform limits, etc. And you know, sometimes people can perceive that as being negative because we all want to make as much money as possible, but you know, we feel it's 100% the right strategy. But what we're going to look at here is the ability to adopt the same discipline in terms of stop loss, but you know, the potential to add capital and risk in the market, given any opportunity, to allow us to benefit more from any up moves or down moves that we're positioned for. So, if you could move the slide on, Chris, and we've only got one slide actually in this section tonight, but I just want to, before I move on to the strategy, I just want to run you through, I guess, me when I was an inexperienced trader sitting at an Australian bank in a busy dealing room, lots of people shouting about, and just put you into a scenario here that may actually strike a chord. And I want to do it just to show you how tough markets can be and how caught up you can get in some of the movements. So if you just move it on one, Chris, I just want to be in this situation where I'm sitting at my trading desk and I've decided, whether it be on a whim or I've been trying to press the button, to jump straight in and buy 100% of my risk. I've got it in my head that, you know, every time I enter the market, I'm going to buy X number of units or sell X number of units. It's that old one-dimensional thing that we try to turn people away from. So I'm in at one price, I'm in at my full amount. And what happens is I sit at my desk and I watch this price action to the right of that black arrow. And I actually, every single number I digest, and it churns around in my stomach. And I actually see and get excited about the fact that the market starts moving in my favor quite quickly. And what I'm doing, on each pip it moves up, I'm really, really tempted to sell. I'm really tempted to take profit. And for no reason apart from the fact that I want to make money and I'm eager to make money, whether it's to build money or to impress my peers or whatever. I'm inexperienced and taking profit's never a bad thing. But actually, the reason I'm doing that is because when I set into the trade, I had no targets, I had no defense mechanisms or anything like that. So I would be sitting here, I wouldn't have put a stop loss in, and I'd be running this market. And I'd see it move up, and then I'd get to these red bars, these red candles, and all of a sudden my mood starts to turn. I'm not quite so happy. I'm nervous that I had a bit of profit in there. And I start seeing the first red candle in that red square that goes down, and I start getting jittery. And one reason is because it's gone down in a bit of a straight line. And then all of a sudden, bang, I get that big green line. And then that's followed by another one. Now, although the candle ends up green and clearly we retrace, we've had a very, very fast downward move in a straight line. And I guarantee you, 75% of the time, I would have panicked and I would have stopped out. And the reason I would have done that is because I had no structure in what I was doing. I was flying the market blind, and I was basically buying because I thought it went up. Now, we do want people to trade off of instinct as well, but if you do this all the time and don't have structure to what you do, you're actually in the long term going to struggle. And the repercussions of me doing what I've just done is that I'll get angry and I'll sulk. All the human nature things, all these emotions that we spoke about a few weeks ago that we really want to avoid. We want to stop those moving out to the extremes, and we want to try and stay as calm as we can. But we just lost money, so we're not going to be calm, and we've lost money in a random way. And so this is one of the reasons, hopefully, I experienced that, and I'm sure Morris, Richard, Chris, we've all experienced it in our trading years, and we had to grow out of this. And hopefully, with the help of mentors and some of these webinars, if this is happening to anybody, then just take a step back and start looking at some of the structured ways we're trying to get people into trades to hopefully give you a longer career in trading and more profits. The other key thing from here is once I'd taken my loss, I probably would have sold. And then when the market started moving up in my favor, but I've no longer got that position, I'd have been sulking even more. And then I start chasing the market. I probably start buying at the highs. I then get worried about the first tick that moves against me, and then my mindset is completely wrong. And even though the market ended up going up, I never shared or participated in that. And even if I got my money back from that initial loss, I would have probably made no money and spent 2 or 3 trading sessions feeling really frustrated and angry. So hopefully, by us showing you some of these trading strategies, you see the positivity that comes with structure. So if you just move that on, Chris, I can quickly go through this strategy, and it's actually reasonably self-evident, but I just want to highlight one thing at the end. So the key thing here is getting your foot in the door. If you buy, you're buying for the right reasons, you've done a little bit of homework, you may want to do a bit more homework. You know where your stop loss is, as we see down there on the black line at 110.75. What we can then do is spend a little bit of time doing a bit of homework and see whether we want to buy. And if we feel we do want to buy, but clearly the more we buy, the bigger our loss will be because we're not going to move our stop loss, we can start looking at lower levels And when we start using Fibonacci's, all the work that Richard shows us with Bollinger's, support and resistance lines, etc., we can start looking at the right levels to potentially buy further tranches of risk in a hope that if the market dips, we can benefit from it. Now, the big plus from here is that everything we're doing is structured. We're planning that trade, we're buying some, we're picking levels and the right levels against some technical analysis, i.e. previous market moves potentially, to buy more so that when our idea comes to fruition, we have more leverage in the marketplace. We've still got the correct stop loss, but this is one of the right ways to trade where you can add leverage and take the benefits when the market moves in your favor. Now, clearly, there may be examples or times where you don't buy any, or you only buy some of those tranches. The positivity that you need to take is that you will still participate in the up move. Everything you did had a good discipline behind it. It had a good thought process behind it. You had controlled emotions throughout it. The one emotion you do have to control is if you don't get all of those tranches, is that when it moves up, don't get frustrated. The positive thing is you're still making money. So hopefully you see here a structured way of adding leverage to the market when it starts going against you. And the starting point is the important one. You went in with just 25% in this example. It doesn't always have to be 4 tranches of 25. That's a formula that you'll make up yourself. But this will help you add structure, it will help you add leverage, and it will keep you positive throughout your trading days. The one thing I'd like to say is you planned this. What you see there was a plan, and then you traded that plan. Please don't confuse this with traders that buy, and then when it goes against them out of frustration, they buy more. And then it goes further against them and they buy more. Because what happens there is they're buying out of panic, and most importantly, they're buying out of hope. They're not buying for a particular reason at a particular level. It's hope that the market goes back up against them. By doing that, they're probably breaking some of their own limits, and they'll end up, when it all gets stopped out below that black line, taking a bigger hit than they anticipated or started out looking to make if it went wrong. So please don't confuse those. Please structure it before you start putting these bids in this particular scenario. Don't buy on hope. And if you keep adding this type of structure to your trading, I'm sure you'll see an improvement to your bottom line. So I hope that helps. I'll be back in a little while, and now I'll hand you over to Richard, who's going to talk about candlesticks as a sentiment indicator. Thanks, Richard.
Great, thanks very much, Roger. Good evening, everybody. If you remember back to the very first webinar that we held, you'll remember that I sort of highlighted the 3 most important areas of technical analysis that I feel are the significant points, i.e. momentum, trending, and sentiment. One giving the speed, one giving the direction, and one highlighting the turning points within price action, i.e. the sentiment aspect. And sentiment is always a very difficult thing to quantify. More often than not, it's a gut feeling. It feels as though the market's doing this. It feels as though positioning is such and such. But I prefer to sort of put something more hard and fast on sentiment, and this is why I use candlestick charts, because I feel that on with the various reversal patterns which we'll look at in future weeks, we can have a great feel for turning points in the market. But something I think that is overlooked slightly is just using one period candles analysis to highlight the sentiment behind market move and what it can tell us. And that's very important when gauging the overall risk within the market. Now, a candlestick chart uses exactly the same information as a traditional bar chart: open, high, low, and close. but the candlestick chart puts on greater emphasis on the relationship between the open and close. So the open is the first reference of value, the close is the last. So every piece of information that's known by the market in that first or last opportunity to trade is reflected in that price. As the market trades higher and closes higher than the opening price, then the body of the candle is colored in green. And you can see the high and the low for the session are reflected by the upper and lower shadow. If the market sells off and closes lower than the opening price, then the body of the candle in the examples that we'll look at are colored red. And again, the high and the low are reflected by the upper and lower shadow. Now, the importance of this real body is that it gives us a great feel for sentiment that's dominated during the day and whether or not we're likely to see potential corrective or even reversal points. The color of the real body gives the information as to what sentiment actually is, and the size of the real body highlights the directional risks that are dominating within the market. So if the market closes higher than the opening price by some way, that reflects positive sentiment. And the reason for that is that the opening price and the closing level, as we say, are the first and last opportunities to trade for that particular product at that particular time. So coming into tomorrow's close in, say, euro dollar, you've got a long position, the market's been rallying, you've got a profit on your trade, you've got a decision to make whether or not you want to run that position over the weekend when you know that you can't trade. Now, if your decision is, yeah, I think we're going to open around these levels on Monday, first Sunday night, and then push higher, you'll do nothing coming into the close. So if that's a market-wide feeling, there'll be no real selling pressure coming into the close. The market will settle towards the upper limits of the day's range, and there'll be no real rejections from highs. So in other words, the upper shadow will be quite small, while the size of the real body, the difference between the opening and close price, will be quite large. So the larger the real body within an upside or downside move reflects the positive sentiment for that day. And this is called a normal standard line. And you see that type of activity within a daily or an hourly chart, it reflects ongoing sentiment, either positive in an uptrend or negative in a downtrend. Now, if your decision coming into the close is, do you know what? I haven't got a clue what's going to happen over this weekend. I've got a decent profit on the trade. I want to take that profit. And when I start trading on Monday, after I've seen a bit of trading from the Sunday night open in Asia, I'll then decide what I want to do. So you decide to take profits. And again, if that's a market-wide feeling, you start to see selling pressure developing from highs. The market sells off. So we start to see rejections from highs, and the upper shadow starts to lengthen. When we actually close, the open-close relationship is much smaller than in a normal standard line, and we may even close lower than the opening price, so we may see that colored red. So this type of activity, a smaller real body of a candle and lengthening of shadows, reflects the potential of a sentiment change, and that this type of activity is highlighting the risk of consolidation. So ongoing positive sentiment, the risk of consolidation as you start to see selling pressure from highs in an uptrend to produce a lengthening upper shadow and a smaller real body of the candle. That type of price action can be very important in gauging sentiment on an intraday or day-to-day perspective. Now, another one-day candle that we can look at is called a doji pattern. Now, a doji basically highlights trader indecision. It's where the market opens and closes at exactly or very close to the same level. Now, depending on where this open and close level is within the day's range, reflects neutral bearish or positive sentiment. So in other words, if we've been trading in an uptrend or a downtrend, and we start to see a doji pattern, a neutral doji pattern, where the open and close for that session, for that period, is mid-range, then we're looking at indecision and the risk of consolidation. You start to see that type of pattern developing after a series of positive standard lines within an uptrend, and this occurs at around the recent highs, then the chances are and the risks are that we will enter into a consolidation. And if you're long the market and you see a doji, you may want to reflect on the overall risk within price action, either pull stops higher or even close your position with the risk of a consolidation. If the open and close is on the low of the day, having traded in an uptrend, and we make a new high for this move, but then sell off aggressively, so we see a lengthening upper shadow and the open close on the low of the day, then that's bearish sentiment. We're rejecting highs and selling off. In the same way that if we're trading in a downtrend and the market sells off, makes new lows, rallies sharply and closes on the high of the day, which is where the market opened, then that's positive sentiment. We're rejecting lower levels and confirming this area as a strong support point. So shadows are very important in highlighting this support or resistance area. Within candlesticks, it's called testing the water. So if the market's trading within a bearish trend and sells off aggressively, but then rallies sharply to see a lengthening shadow, this area is a confirmed support point and a level that we shouldn't break below if we're starting to see more positive themes emerging. So in this example, lengthening shadows, either to the up or to the downside, reflect the potential of a sentiment change. Now, this just happens to be a daily chart of sterling versus the US dollar, and you can see the lengthening shadows occurred at lows and highs of price action. So as soon as we started to see this type of price action, where we made new highs, rejected sharply, and the open close relationship was much smaller than those that we've been seeing, then that's an indication of a risk of a change of sentiment and the possibility of a correction or even reversal developing. So the sentiment on that particular session is highlighting the risk of change and at least a consolidation correction materializing. So if we use candles alongside, say, a Bollinger Band, we can build the scenario where we're looking at price action, we're looking at the sentiment on a day-to-day basis and how that starts to develop. So for instance, on this first candle, we saw a lengthening upper shadow as the market rejected and sold off. We did see a sell-off, but the volatility within the market remained fairly steady. So we have formed a sideways trading range. So while this was important in highlighting sentiment, it didn't reflect an outright negative development. It was the end of the upside move. So the sentiment shift was one of consolidation and the market moved sideways. However, having pushed to new highs and rejected, within this example, we then saw a bearish standard line to the downside where the market closed some way lower than the opening price. It also broke below the mid average, which then started to turn lower. We then saw further bearish standard lines where the market then started to tag the lower Bollinger Band and volatility increase where the band started to widen. We then saw consistent negative standard lines developing as volatility increased until this session here, where the market rallied sharply, but then again rejected higher levels, and we saw a lengthening upper shadow and the risk of ongoing negative sentiment. So this becomes a focus of resistance. This high that we rejected from becomes a focus that we wouldn't want to see broken if the market stages a recovery. So in other words, we would place our stop above that point, because if we do start to break above that level, it would reflect something else changing within the market. So in other words, we've overcome a previous resistance level where the market's rallied back to and sold off aggressively from. We've broken above that and started to see positive standard lines. So By using the daily candlesticks, we can see sentiment. And a question that you should always ask yourself whenever you see and use candlestick analysis is that you can go into the session. If you're long of the market because you've been seeing standard lines, you go in to the next session with expectation of another positive standard line. So you need to ask yourself at the end of each session, did the latest candle fit with my expectations? If it was yes, if we put in another positive standard line within an uptrend, then that's continuing ongoing positive sentiment and we hold the position. If no, if we started to see rejections from highs, lengthening of upper shadows, you then need to ask yourself, do you need to move your stop or do you actually need to close your position if you've seen something more aggressive in terms of, say, a bearish doji pattern? What are the other indicators showing? So using Bollinger Bands alongside that, are they confirming the potential for a change? And the one question that you should always ask yourself when you're using technical analysis, when you're thinking about closing a position, is has anything changed within the technical picture to mean I close my position? So in other words, have the candle activity, is the sentiment within the market reflecting a change and a potential move against the ongoing trend and the reason why I've taken my original position? So that's candlesticks. What I want to do now is just flick over to the live charts, if we can please, Chris, and just quickly run through what we're currently seeing within price action and within candlestick charts. Now, you remember the doji pattern. I'm going to start with the weekly S&P chart, and you can see that last week formed a doji pattern. Not necessarily an aggressive one because it's more or less mid-range, so the open and close are at similar levels. This, to me, having failed to break above this previous high, was a warning signal that something could be changing within the market from a sentiment perspective, and that we need to watch price action more closely to highlight and gauge how serious this potential sentiment change is to be. So we then flip to the daily chart, and we would use something like Fibonacci's that we've obviously recently looked at to highlight the daily support levels to the downside that we need to monitor. Now, taking the latest recovery point, so we've got the weekly doji pattern reflecting the potential of change. Looking at the daily chart, we've got a series of negative candles and a correction back to the 38.2 level at 3419.2. That is the first support level I would now be monitoring against the potential sentiment shift within the weekly perspective. If we start to break that retracement level, then the risks could turn towards a deeper sell-off. And that weekly doji pattern would be an indication that something perhaps was beginning to change within the market to see a more extended sell-off occurring, especially if we break this retracement point. So again, the evidence is that potentially is there for a change. We then need to watch price action more closely and highlight the important support levels, which if broken, would trigger a more significant change within the market. And certainly on a daily perspective, it would be a break below that first retracement level. Looking at the DAX, again, we haven't really changed our DAX commentary or outlook for a number of weeks, and that's been within this choppy sideways trading range. And we've been trading either side of the midpoint of Bollinger Bands. So it's a boring trading range, if you like. But the important point for now is that having started to see more negative candles developing again, it's not aggressive, but we're starting to see selling pressure developing, rejections from highs. If we now start to break this trend, connecting these recent lows, this would look to be a more serious deterioration, a distribution area, a reversal pattern to this strong upside move, potentially bringing about a much more aggressive retracement move, and that would expose a deeper retracement of this recent strength, highlighting these retracement levels as potential points, as next support points, if the market starts to sell off aggressively. So we've got important levels to monitor, and this neckline, this trend line support on the DAX stands at 12,388.9. So again, that combined with the retracement level that we have in the S&P, for me, are the important points to watch in equity markets. They start to give way, it would reflect potential of a more serious change. Now, switching to the FX markets, basically the dollar has really been quite a difficult currency to trade for the last week or two. It's been very choppy. We haven't really sort of seen any clear-cut signals developing. And euro dollar is a good example of that, in that the daily chart effectively is still within this choppy sideways trading range. The dollar weakness this week is attempting to see more serious upside moves developing, but to be honest, it really only breaks above this high around the 119.17 area that would suggest a more prolonged upside move. So really for this stage, the dollar is still, while we can see further selling pressure, is still within more choppy activity. Cable's been very interesting today, as Mo was talking about earlier, in that the hope of the Brexit agreement has seen sterling find support. And yes, it may well be the case, but we need to see evidence of that and confirmation of that. However, from a technical viewpoint, and this goes back to the Fibonacci comments that we had the other week, look where the market held on today's strong upside move. So from a candles perspective, this is a positive sentiment session. We've closed significantly higher than the opening price, no real rejections from highs. We've seen nothing but buying from the open of the session, so there hasn't actually been a low under the opening price, and the market recovery has been held by 131.74, which is the 62% retracement of the sell-off. So again, having broken above this 50% level, which from a short-term perspective for me today was a trigger to look for acceleration to the upside, but this retracement point at 131.74 is the next focus. We would need to break above that to trigger a more prolonged upside move for sterling, weakness for the dollar, and then that would effectively point back towards these highs around the 134.83 area. So again, and a very important point to watch. Now, we've highlighted negative Aussie dollar sentiment over the last few weeks within these webinars. Morris has spoken about it, continues to highlight the risks. Technicals have continued to highlight it. And this is the sterling Aussie chart. So Aussie's already been underperforming and sterling started to see support developing. Well, Aussie did recover today, but even against sterling, we've continued to see upside developing. So sterling outperforming Aussie. And you can see that we've broken above this trend resistance that we've spoken about before. And that looks to be also breaking the last recovery highs and the risk of a more extended consolidation, more extended retracement of this downside move. So again, the evidence here is that sterling is set to outperform, more so against the underperformers, which is the Aussie dollar over the last few weeks, but it could be developing elsewhere. And certainly if cable starts to break above that resistance point, it could be a potential trigger for higher levels. Then finally, I just want to take a look at Aussie CAD, because this is another one, another cross that we've been looking at against this potential of a reversal pattern, the break of the trend, the neckline, whatever you want to call it. The recovery today has been quite strong for Aussie, but again, it's important that you use these candles within the overall structure. You quite often see a normal pullback to the old support level. So in other words, the market breaks lower, sees the acceleration to the downside, but then recovers and corrects back towards the old support to test that, to produce a pullback. And that often offers a selling opportunity. So we'll be looking at this area as being a resistance point, and technically for the Aussie to encounter fresh selling pressure and continue to see an extension of this retracement point. So even though we have seen a positive candle for today's session, we have to take it within the overall structure. So this is a fairly significant resistance area. So this positive sentiment that today's activity reflects needs to be developed more. We need to break above this neckline. We need to see more significant support developing. So within the overall structure, this still looks to be a pullback towards a reversal area. So that's the candlestick. So Chris, if we can go back to the main presentation, please. That's looking at the general sort of structures that we have at the moment, and hopefully you can see by using the one-day candles how we get a feel for sentiment and how that's developing on a day-to-day basis, and how that is likely to relate to price action, and how we're likely to see that evolve just by using the one-day patterns. We'll look at 2- and 3-day patterns over coming weeks, but certainly hopefully that gives you a good idea of how we can use candlesticks for a sentiment perspective. So I'm now going to hand back to Roger, who's going to look at something that we highlighted over a previous week within the technicals, and that's looking at the support and resistance levels. And Roger's going to look at how we can actually trade by using those support and resistance points. Thanks, Roger.
Thanks, Richard. And they're quite appropriate there as I look at that Aussie-Canada chart, because I see signs of what we're going to talk about there. So maybe worth reflecting on that. But yeah, tonight we're going to just run through a couple of tips really around trading, you know, support and resistance levels, sideways movements that we may see, and potential breakouts of those technical structures. And you know, these do provide opportunity if we see them. They're different trading styles, and again, it's important to have discipline, even though sometimes you may be in a sideways movement where volatility is quite low. But you know, as these structures build, you know, they will not go on in perpetuity. So you know, we need to be careful when these things may break down, and we may see some moves out of it. So just a couple of slides tonight, and on this one, and I want to run through first a bit of a recap on what Richard showed the other week, and that's exactly why we get these structures. So it's important to understand what's going on behind the scenes in terms of building the support and resistance lines. And it's quite simple in terms of markets moving up and down within a reasonably tight band. And all those people that are looking to buy below the support or sell above the resistance are missing those opportunities. And so over time, either frustration or customers bringing orders in lower or higher, they move those orders in, and potentially those you know, more and more participants on the support and resistance lines actually bring those ranges even closer. But as we see there, at some point there will be very, very few or no offers sitting on the top, or support bids coming in below. So at any point we will get an acceleration out of that range, and that provides an opportunity, but clearly also provides danger if we're still trading the range there. So bearing all that in mind, I'm just going to move on to a couple of tips really. If we're seeing a structure here and we feel volatility is low, and a currency pair or asset class is starting to show signs of this pattern, then one of the key things for me, if we want to participate in this, and you know, sometimes these differences between support and resistance can be, you know, a couple of hundred ticks and worthwhile, and it may take 4 or 5 days for it to trade from the support all the way up to the resistance. But you know, it should be good money if we can trade it right. So as we play it out, one of the key things for me is your first entry point into a range. I would advise you do it from a perspective of where you actually believe your underlying view of that market may be. So although we may be in a consolidation phase here, what I've got here, the first action would be to sell as we move up to the resistance level. And one of the reasons I do this is because you'll find that all your decisions afterwards become a lot more natural. If you sell and it goes down, it's much more natural to buy in front of that support level. And in actual fact, it's more natural for you to put that nice tight stop above that resistance level, because you actually think it's going down and you'll be nervous if it goes up. And I feel this will put you in a more comfortable zone in terms of playing this range. Over time, you may get the experience and the confidence to look to pick up both sides of that range. But I think if you're going to start this type of trading, then I would look to maybe pick up one leg of that until you get a few trades under your belt and you actually get more confidence in this type of pattern. So as we said, this range will narrow, and at some point, because of that reason, when you're putting your sell orders in to instigate short positions, when you're looking to buy down there on the support line, don't be greedy. Remember, lots of people will be looking at these levels. So actually, we talk about smart execution. Put your offers and your bids in a little bit below the resistance line, a little bit above the support line, to make sure you get executed. It's important. It's frustrating if the market goes down very close to that line. Let's say that support line there was at 20, you put your order in to buy at 20 and the low was 22, 23. That little bit of greed can frustrate you and actually spoil the whole transaction for you. So a little bit of smart execution there. And it's that every time we get to these support and resistance levels that we have to be really attentive. And I think this is one of the important things. If you're trying to trade these ranges, whenever you see the market getting to the highs or lows of this band, you have to be attentive. You have to be looking at price action. You have to be looking at price momentum. You have to be scouring the news just in case there's another scheduled event coming up, a piece of data that might really influence a breakout of this range, any news that's coming out on the horizons. And it's very, very important. These things will not carry on and keep feeding you money. At some point, they have to break, purely because that's what markets do. And when they break, as we suggested, the vacuum will make sure that the price action will be accelerated. So as we move on, Chris, I think to the final slide, we do have an example here. And again, just briefly, I'll go through it. You can see on the left-hand side, we start to form this range, and we start slightly wider, and then slowly this range closes. And we would do exactly as we spoke. The one thing we do have to be careful of on all of these, obviously, and markets will tend to do this, is there will be false breaks. So again, one thing around your execution and your order levels on those stop losses, we want them to be tight, but there may be false breaks that take your stop out. It's very, very unfortunate. You may get an opportunity, if you're attentive and it goes back below after a false break, to sell out again somewhere close to that resistance level as we start that downtrend again. Again, that's another good reason why you need to be attentive around those areas. But please understand there will be some false breaks and you may get caught up in that. So, these ranges, it's not a given that you're going to pick up that range on every single move from the lows to the highs or vice versa. So once we get to these ranges, if I look on that right hand side, we know, because we've just looked at the structure, that all of a sudden there is a supply vacuum. And in this instance, the supply vacuum is to the top side, merely because there is no more supply. There are no more offers in the marketplace. And each time anybody who's either short or they decided to trade this break, like we may be looking to do, we are basically looking for offers to get into that trade. If there are none, everybody's chasing the market will accelerate, it will go in one direction. So we're looking to capitalize on that supply vacuum if we're playing the next strategy, which is to trade the breakout. The important thing about trading that breakout Once again, you may get a false break, so don't be surprised on that one. But you can just see in this example the price action on that final move before the breakout. You see a strong move from the low to kind of 2/3 of the way up the range, then it moves and it touches that high. At that point, we're making those decisions. Are we going to sell again? I think, you know, the way the price came back off, there's a good chance nothing was going on in the market to spook us there. So we may well have put that short on. But then we start looking at that price action. Again, you've got that neutral doji that comes in there. Is that telling us there's some uncertainty? Then we see a strong candlestick, bullish candlestick moving back up towards the resistance area. It's at this point that we start probably getting a feel. Is there some news behind that, or is it just price action? Is there a big buy order starting to come into the market that's taking out all of this supply? That's where we need to be attentive. And at that point, we're either taking ourselves out before we get through that resistance, if we're concerned about it. That then gives us the option to try and play that supply vacuum and buy on a break and get ourselves long. So we've gone out of range trading, but we've given ourselves another trading opportunity, which is to buy that break. If we don't think there's a big break coming on or whatever, we've clearly got our nicely planned tight stop above that break. You may get a bit of extra slippage in a stop loss because the speed of the move, but again, you're disciplined, you're structured, you've got your stop loss in place and you're protected. So however we do that, the whole thing here is discipline. It's about smart execution, and hopefully we've given you an opportunity to understand why these patterns develop and allow you to trade off of them. So that's our trading strategies for this week, and I'll hand you back to Chris for some questions.
So thank you very much, Roger. Thank you to Richard and Maurice as well. Some great content this week. So just if you do get a chance, we are on social media, Instagram, Twitter, and LinkedIn. We'd love to connect with you. So if you do get a chance, then please connect with us. Just straight on to the questions. One for you, Maurice. Came in right at the very start. As far as Australia and China are concerned, can China really do without Aussie raw materials like coal and metals?
They are developing. It's an interesting question, actually. They're developing quite strongly towards a more consumer-based or services-based economy rather than a manufacturing and infrastructure-based economy. But it's a valid point. There are other places to get some of these. Obviously, Australia's not the only producer of iron ore, which is one of their major ones. But yeah, I mean, that is a fair point. So, whether this is politics or whether it becomes something else, possibly depends. But we are seeing a slightly more insular view between the two superpowers, which is leaving this gap in the middle. But yeah, it's a valid point. But I think they may be past the total reliance, and I think China is going to start making some moves towards a cleaner energy policy. So coal was a natural target, really. Whether they can do without beef and wine, look, they can put pressure on Australia on things like that, and Australia does want to, they can get beef and wine from just about anywhere. So I do think Australia is slightly exposed to this still. So that's the only thing I would say. But it's a very good question, to be honest. But I think Australia can find ways around it if they want to play politics with Australia.
On the China thing as well. So China seems to have a lot of problems with many countries, Europe, India, certainly the US, the UK over Huawei, things like that. Can they survive all that because they're doing so well and they are so strong, and and obviously they're coming out of this virus period, much stronger than everyone else at the minute, or do they have to, concede something?
That's a very, very good question. I mean, the situation here is that I think what a lot of people don't realize is that China is becoming more reliant on the global or outside funding, capital flowing in. They need people to start investing in their infrastructure issues as well. And I think realistically, China is more reliant on the outside world now than it has been in the last 30 years, possibly even longer. And I think what we're seeing is them understanding that and trying to internationalize markets. But at the same time, unfortunately, they've run into Trump, who is stepping back away from globalization, which is creating this polarization of the two major superpowers. And unfortunately, what that creates is a breakdown in the supply lines that we have in place. And there's going to have to be a shift, and it's going to be difficult to get that done without some kind of destabilization, if you like, and also an impact on global trade. So I do think overall that's a little bit of a negative that's ongoing. Whether the election changes that or not will remain to be seen. But I do think with the COVID as well in place, as you know, global economies are going to struggle to recover to what they were. And you know, what is the new normal? I mean, we're already seeing so many companies cost cutting, embracing technology that's available to cut costs and cut staff. You know, the whole package together does seem that we have an awful lot of headwinds in front of us, although we are seeing a bit of a knee-jerk bounce after the unlocking of China. Whether we get the same in Europe or the US remains to be seen. But yeah, China is a conundrum at the moment. I think they would like to settle this, but their nature and their culture is to, well, look, if you're pressing on us, we're going to press back. And that has negative connotations for us all, to be honest. And also there's the geopolitical issues that sit with Taiwan sitting right in the middle of the hot zone. So I think we need to be careful of that because that could be a problem going forward, that could change everything on the geopolitical front and threaten, you know, possibly even global peace. Who knows?
All right, thank you very much. We have one final question on the US virus aid plan. You said it's ongoing. They're chatting right now, and there's all sorts of headlines popping up regarding that. You talked about there was a lot of hope in the markets. Do you think that is this the last chance for a virus? You know, if they don't have this deal today, is that sort of done till after the election? And do you think that would be really bad or potentially bad for stock markets?
Well, I think the stock market was hoping to get something yesterday. They had a deadline that passed. They then said they'd speak today. I've just heard that Meadows, one of the advisors, has suggested that they will be speaking again and want communication over the next couple of days. So, you know, these deadlines obviously mean nothing, but I hear that the Republicans are up to 1.9 trillion. Pelosi's still hanging out for 2.2, but I do also hear that the differences are what they actually spend the money on, and the Republicans have a real problem with state and local aid. So I'm not sure if they're there yet, but if it does go into after the election, then I do think that is a problem for the risk markets. Whether that's today, I'm not sure, but if we got a negative headline, for instance, if Mnuchin came out or Pelosi came out and said, right, okay, talks need to end now, we need to concentrate on the election, we're going to deal with this afterwards. Yes, we may get a deal, but that gap is going to be very concerning because investors don't like uncertainty.
All right, and do you feel the same towards the Brexit talks, which obviously Sterling had, as you said yourself, Sterling had a big rally today, as they said that they're going to restart that again. Is that more hope because, you know, they're coming to the table, but there's a big but?
Well, I do think that Johnson and Frost would not have accepted that offer unless they'd called and said, look, don't bother coming unless you've got something to concede, because we're not, you know, what's the point? So I'm hoping the fact that they've said, look, we do want to intensify these talks. Barnier is coming over tomorrow, and maybe we can sit down and get this done over the next 2 weeks, that they've offered some form of olive branch in that. So I think the market, as again, forward looking, has priced in this hope that they can get a deal. Whether there is one or not remains to be seen. I think there's some relative insurmountable differences between the two, and there's been some red lines very publicly drawn. Someone's going to have to back off, and I'm not sure who it's going to be.
All right, fantastic. Unless there are any more questions, so we'll give it, you know, a minute or so. If there's not, I think then we'll leave it there for tonight. So just bear with us one sec. All right, so I think we'll leave it there. Thank you for attending this evening. Thank you to the mentors for the presentation and the content. We're back next week. Obviously, we're getting very close to the election, so we're going to have a big piece next week on discussing, you know, the permutations of the US election, which will be 4 or 5 days on from that. So we look forward to speaking to you then. All the best. Have a fantastic trading week ahead, and we'll see you soon. Thanks very much.